Thinking of buying a home? And if you're a first-time home buyer, you probably have a lot of questions. And one of the most common questions that I've been asked is about the mortgage. Should I go fixed or should I go variable? In this video, I will share with you some of the features of fixed and variable rate coming right up. Hi everyone, Lei Villar-Cisneros, your real estate go-to expert in the Greater Toronto area, where I help families like yours achieve their home ownership goal. Today's topic is about mortgage. Should I go fixed or should I go variable? Let's talk about fixed mortgage. So one of the features of fixed mortgage is, as it says, it is fixed. So that means whatever the first rate that you get during your commitment signing will be the same rate that you will have for the remainder of your term. So for example, if you have 3%, now you will have 3% until the last payment of your mortgage. What's the advantage of that? It will be easier for you to budget. Most of the first-time home buyers that I dealt with, they opt for the fixed mortgage, especially if your budget is tight. If you are going paycheck to paycheck, there's no extra money that's coming in and you don't anticipate your income to be anything higher, you have a lot of expenses that are on your plate, then I think the best route for you is to go fixed. But there are also cons to having a fixed mortgage. So for example, if you decided that you wanted to break the mortgage, breaking a mortgage is when you don't complete your term. So most common term for first-time home buyer is 5 years. So what if you decided on your third year, which is, by the way, according to statistics, is the time when most home buyers kind of change their mind or break their mortgage. So let's say, for example, on your third year, you decided to relocate somewhere or decided to sell your house. At that time, you need some renovation money, or some people use refinance for vacation. There are things that you have to learn when it's fixed. The idea is for you to be able to complete your term. But if you break your mortgage on a fixed term, penalty charges will be higher because it is the higher of the IRD, or the interest rate differential, or the 3 months interest of the mortgage. Depending on the lender that you chose, the penalty can be as high as $10,000 on a fixed rate, or it can be $1,200. So that is another video that you have to watch out if you are thinking of choosing a fixed mortgage. Now let's go back to our topic. Variable rate. As the name suggests, the rate varies and it rides with the prime. So like for example, right now the prime rate is 2.45. If you have a rate which is, say, prime minus 0.2, so that means 2.45 minus 0.2, that will give you 2.25. If the prime rate goes higher, your rate will be also higher. Now, what's the advantage of having a variable rate? When the prime rate is down, and you will have to pay lower monthly payment. What actually they do right now is an adjustable rate. So if the prime rate is lower, they adjust the payment for your mortgage and you will have to pay a lower higher mortgage for monthly. To some, that is a little bit stressful because when the prime rate keeps on going up, then you don't know when it's gonna stop. Now, one of the advantage of variable rate is you can convert once in the lifetime of your term. So for example, if you're getting stressed with the prime rate going up and up and up, and you wanted to do a fixed rate, you can do so one time. The other advantage of a variable rate is if you ever have to break the mortgage. As I was saying earlier, breaking a mortgage is when you did not complete the term of your contract. So you kind of breach the contract. So you have to pay penalty. For most mortgages that are variable, the penalty is just 3 months interest. So it's not as high as it would be if you have a fixed rate. So that means that if you have to break your mortgage a couple of times, then the penalty wouldn't be as high. The disadvantage of that, if you have a fixed income, you have a lot of expenses, then it is kind of harder to budget. Nowadays, more and more people are choosing to go with variable rate. So as you know, both mortgages are good. The difference is if you are a risk-averse person, then you probably would like to keep the fixed rate. If you are okay with the ups and downs in the market and it doesn't bother you and you have some room in your pocket in case that the price goes up and you're okay with that, then go ahead and do variable. Each is different because of your situation. One of the tips that I could share with you if you are doing a variable rate is to keep the same monthly payment when the rates keep falling down. That way, that money will go straight towards your principal. In my next video, I will share with you how to save more on your monthly payment so that you would be able to pay down your mortgage faster. So that's it for today. And if you haven't subscribed yet, do it right now. And thank you so much for watching. I hope that you learned something in this video. Bye for now. Don't forget to share.